It's a big day for the India story. One report and one set of data has set the stage for a conversation on the Indian economy. India's GDP grew at 7.2% for the financial year 2022-23, exceeding expectations and placing it firmly in the list of fastest growing nations at a time when the world prepares for slowing growth. A report by research agency Morgan Stanley explains why, but broadens its outlook on the last decade. It says India has changed in the last 10 years and it's because of key policy decisions. So let's take a look at what this report says and what the top highlights are. So the report says that today's India is different from what it was in 2013. India's transformation is because of policy changes. And in the last 10 years, India has gained positions in the world order with significant positive consequences. It also says that India is set to become the third largest economy at $8 trillion by 2031, and it will drive a fifth of global growth through the end of the decade. India is set, as per this report, to emerge as a key driver of Asian global growth, and India's next decade, importantly, will resemble China's growth in 2007 to 11, which is when their GDP was zooming. Now, why is this happening? Morgan Stanley, in its report, has actually listed out the key 10 reasons, and we're breaking it down for you very simply. Number one, they put it down to lowering of the corporate tax rate. The corporate tax rate at its lowest levels in India till the year 2024 will be at 15%. This is on par with nations around the world that are trying to attract corporates to come and set up business and manufacturing. The second big reason is the development of infrastructure that has picked up pace in the last year. Couple this with a steady increase in GST collections. For the last many months, over a year actually, we've seen consistent GST collections month on month over 1 lakh crore rupees. Number four, increase in digital transactions as a percentage of GDP. From about 4.4% in 2016, it's at 76.1% today. Laws to regulate real estate sector has also been a big contributor. According to this report, they're talking about the RERA law, which has increased the confidence of buyers when it comes to purchase of real estate. The other big factor is direct benefit transfer for government schemes. Remember the troika of JAM, Jandhan, Aadhaar and Mobile, where schemes that are supposed to be given to beneficiaries from the government now reach directly in their accounts. So looking back at the last 10 years, that's one big factor that has been identified. The other one is the Insolvency and Bankruptcy Law, the IBC code, which allows bankrupt companies to be bought more easily, ensures that there is some kind of a collection for banks whose monies are stuck. The other point that has been noted is India's successful handling of inflation with a flexible inflation band that the RBI has maintained between 4 to 6% and helped us decouple our monetary policy from what the Federal Reserve does. The other factor which is important, and they're calling it India's 401k moment, is higher retail investments in stock markets. This highlights the fact that today, more than ever, average Indians are using equity or investment in stock markets as a way to save for the future, instead of just the traditional fixed deposit kind of instruments. And, of course, the increased focus on FDI. So what does all of this do for India? Well, as I mentioned, India is set, as per this report, to become the third largest economy at $8 trillion by 2031. It also means that manufacturing and capital expenditure as a percentage of GDP will be rising. India's export market share will hopefully double to 4.5% by 2031. And per capita income, at the end of the day, if the average Indian doesn't make more, then how does it matter? So per capita income is also set to increase from the present 2,200 USD, that's an annual figure, to 5,200 US dollars by 2032. This could mean reduced inflation and greater price stability. The current account deficit will also reduce as per this. But there are challenges ahead. Let's not forget that we live in a global, very closely connected world, and global recession is a key concern right now. Nations across the world, developed nations, are facing that fear. A fragmented general election outcome in 2024 is a key risk that Morgan Stanley, this research agency, has identified for India's continuous growth. A rise in commodity prices due to supply-side issues is also a key concern because India imports a lot of commodities, including crude. A shortage in skilled labor supply is also a key concern. So that's the Morgan Stanley report, but let's take a look at what experts are saying. All right, to speak to me on, this very interesting report from Morgan Stanley, State of Economy and Impact of Modinomics and more, I'm joined now by KV Subramaniam and Rajiv Kumar, top economic minds who have very closely observed and been part of some of the policy measures that Morgan Stanley says have contributed to this optimistic outlook of India. So glad to be speaking with both of you today. Thank you so much. Mr. Rajiv Kumar, let me begin with you on some of the points that Morgan Stanley makes in this report. And primarily, it talks about policy decisions that have changed the perception and the trajectory of India in the last decade. They start from 2013 onwards. What would you say has been the biggest game changer? Is it IBC, GST, RERA, or a combination of all of these things?
Hi, Tamanna. Great to be here. And it's good to see the Morgan Stanley report giving India such putting India in such glowing terms. And clearly all of that you said, plus more, all together have come together to make this, in my view, what I call the India's moment, which we need to seize. Whether it's the formalization of the economy, or the introduction of the GST, or the RERA, or the Insolvency and Bankruptcy Code, or it's the reduction in the corporate tax rate, or the changing the definition of the small and medium enterprises, the targeting the people at the bottom of the pyramid, keeping inflation in control. Essentially, the policy regime that has been put in place, which is now showing results. And given what we've got in FY23, a 7.2% growth rate, and the last quarter coming in at, I think it's about 6.1, shows that the momentum is not flagging but is continuing. And for me, the biggest news is the turnaround the private investment cycle. I think, and there are reasons for it which are related to policy. But that, I think, is the biggest news, because henceforth you can then expect, the growth to continue on the basis of private investment, which had flagged down, but is now beginning to pick up again.
When we talk about the last 10 years and sort of the timeline that the Morgan Stanley report addresses, I think it's also important to see what was happening at this point externally and in the world. And let me bring in Mr. KV Subramanian here, because to look at this without identifying that this is when pandemic took place, so about 2 to 3 years there, then you have a Ukraine-Russia war. You had in the beginning of, I think, this period, or closer to the beginning, the impact of demonetization. You have fears of a global recession right now. Is it very important to see all of these measures in the context of what was going on during this period?
Very good evening to viewers, and thank you, Tamanna, for providing me the opportunity to share what is a phenomenal story in terms of the economic outcomes, both in terms of the macro developments as well as in terms of equity or micro developments over the last 9 years. And I think the Morgan Stanley report earlier, a couple of days back, the Jeffries report also talked about the same thing. A couple of important points. I think if we look at over India's 75-year history, in my opinion, and I think the data back that up, there has not been a previous time when India has been such a positive outlier, not only on macroeconomic fundamentals, but also on growth and also on measures that we care about in terms of equity. I think that's something which is very important. Amidst a poly crisis, as you rightly said, starting first with the starting with the COVID pandemic, once in a century pandemic, followed immediately by the Ukraine war, we've been able to come out with very strong macro fundamentals and with growth that is 7.2%, latest estimates. If we go by the previous, instances, I think this growth will get revised further upwards, as we've seen, in the previous 2-3 years. So next year, when the revised numbers come, I would expect growth to be north of 7.5%. In a global economy that is struggling to grow at even 1% or 1.5%, I think 7.5%, India actually is phenomenally good. I think that's something which we have to acknowledge. It has come because of the very sagacious policy response that was followed, after the COVID crisis and recent times as well.
All right. So, great news coming in from Morgan Stanley. GDP numbers, like you mentioned, above expectation and exceeding expectation at 7.2%. Q4 has been robust. Now, let's sort of look at the flip side. When we look at the last decade, and I'll come back to you, Mr. K.V. Subramanian. When we look at these policy measures, the counter is IBC, great idea, but look at the implementation, mired in judicial tangles. GST was need of the hour, but look at the number of slabs. Shouldn't it be a cleaner version with a less number of rates? And did it really hurt small industry in the initial phases of GST? Manufacturing has grown in India. Corporate taxes have been cut, great for corporates, but has manufacturing grown as it should, or are we at our optimal level for an economy of our size? What would you say to some of these points?
So if we look at the overall, I think there is no doubt that there's been a lot of progress. Having done research in this area on bankruptcy codes, I would highlight, even in the US, if you would recall, viewers, the US passed its bankruptcy law in 1978, and it is not as if the United States hit perfection with its bankruptcy law immediately. This is something that is generally true, where you have to craft into perfection, recognizing that a good policy change should be something that is allowed. Perfection should not be the enemy of good, and that is something that we've seen with the IBC. There's more work to be done, but I think clearly, if we look at the delevering that has happened, and overall the banks, portfolio is improving significantly, the stick that the IBC provides banks with is something that is working, but there's more work to be done. When we come to, some of the other aspects, GST, I think some of those teething troubles have been ironed out now, and overall things are looking up. I do want to highlight one more aspect, Tamanna, because a lot of commentary when the macro numbers look very good, some of those who actually have this habitual, tendency to only look at the negatives will say, oh, what about employment? And I want to actually provide some key numbers there using the PLFS data, which is the official data. A lot of this negative narrative relies on the unreliable, noisy CMI data, and I'm not going to comment on that. But if we look at even, pre-COVID, the number of salaried jobs that was created 2017-18 compared to 2019-20, 15 million increase in salaried jobs. And if you look at the overall formalization itself, close to 12 million, formal sector jobs as well. And even if we look at, during the COVID period, all the measures that typically labor economists would look at, unemployment rate, worker population ratio, labor force participation rate, all of these have registered actually V-shaped recoveries. They're above pre-COVID levels. And in particular, last fact, which is important, people talk about the labor force participation and female employment. Yes, it is the case that for males, the recovery was a clear V-shape. It was a sharp recovery. For females, it was flatter. But if we now look compared to pre-COVID levels, female worker numbers actually have increased close to 40%, which is about more than 4 times that of males at 8.6%. So I think these are important facts that we must keep in mind, lest the commentary only focuses on some of the negatives.
We live in interesting times, I must say, when even economic commentary is bucketed into positive and negative narratives. I mean, numbers are numbers. And you talk about CMI, or this Morgan Stanley report that everyone's so excited about. quote CMI as one of its many sources. So, I suppose it depends on how you want to look at it. But you came to employment, which was going to be one of my next questions to Mr. Rajiv Kumar. If we look at the progress made in the last 10 years and what we need to prioritize now, would quality employment, not just the top line numbers of how many people have some kind of employment, would quality employment be a big priority in your view? Boosting manufacturing, a big priority, and also reducing the gap. This, our favorite term post-pandemic was K-shaped recovery. Reducing some of that K, would that be important?
Tamanna, employment is a very big issue. And I tend to believe that we have to focus much more on improving our labor force participation rates. It still is about, I think, 47% or so. And that just means that 53% of your workforce is still not in the organized workforce, and they are self-employed, et cetera, And that is what needs to be done that's what's got to be the major focus. The female labor force, the participant rates are even lower, despite the recovery in the post-pandemic period. And the other important thing is that in our country, we can't follow a model of mass migration from one region to the other, which is that at the moment, if you notice, there is this migration from the north and the east to the south and the west, and that's simply not sustainable. So we've got to also create employment in the areas where people live and where populations are going to rise, which is in Bihar and Jharkhand and Chhattisgarh and so on. So we got to create jobs where people are. Now, all of this to me requires not just a focus on manufacturing, because it doesn't matter where quality employment comes from. It can come from the services sector, it can come from agriculture, it can come from agro-processing. The point is about raising income levels and productivity levels in areas where people are living at the moment. Now that, I think, can be best served by giving a much bigger focus than what we have done so far on exports. Traditionally, our exports have been linked to the global economy, how the global economy fares, and now the global economy, we find there are threats of recession, both in Europe and the US. This is the time to increase India's share in world trade markets. The Morgan Stanley report says that our progress, one of the factors that it says is that the share in world trade, India's share in world trade, should rise or will rise from 2.2% to 4.5% by the end of this decade. Now, that's the target to achieve. If we achieve that target, then quality employment will be generated. Quality employment can be generated where people are and not lead to this huge migration, as I said, from one part to the other. So employment remains, I think, an issue, despite what Subramaniam has said, which is that, there is a improvement, et cetera, in salaried jobs. I think employment does remain an issue, and I think to that is related two things. One, a massive focus on export expansion, and two, improving our agricultural and agro-processing sector and making sure that India gets, at the moment, 45% of our workforce is employed in agriculture and producing only 18% of GDP. That must change, and it can change if we follow the right policies, and that will also generate jobs where people are.
Okay,
and if I may add,
yes. Please go ahead.
I do want to, because you talked about the CMI report, I have consistently maintained, irrespective of whether the news that comes out from CMI numbers is good or bad, to me it is closer to noise. It's not reliable. So I would not quote the employment data in the Morgan Stanley report. As for the quality of employment, I think this is important. When one talks about salaried employees, when one talks about formal sector jobs, these are definitely speaking to the quality of employment, and the numbers that I quoted are important. That said, I do agree, with what Rajiv ji is very rightly pointing out. I think the potential for manufacturing itself to expand more in the smaller towns is much higher. I'm sure our viewers will appreciate that maybe a few years, 3-4 years back, I couldn't, sitting here in Washington, D.C., do this interview with you. And in a similar way, I think supervisory folks, in cities can supervise some of the employment that can happen in manufacturing, in the hinterland or in small towns, because labor costs will be lower, or land costs are lower. These are opportunities to realize. Last anecdotal point on exports, just to, for instance, the yoga instructor that I have actually back in Saharanpur in UP, he does yoga for me on the web. And so a service sector like that, and I pay him, by converting by dollars now. So that is, a sort of illustrating the potential there is for increasing service sector exports. And I think would second what Rajiv ji is saying. It's a very good time to actually double down on export policy and also on manufacturing in some of the small towns in India.
Absolutely. I hope your yoga instructor is, keeping you in good health all the way from Saharanpur. But that's an, interesting example of how technology can help extend the expanse of the Indian economy. So much more to encapsulate, but unfortunately not enough time. I will have to wrap it here. Thank you so much, KV Subramaniam and Rajiv Kumar, for joining us today.